MasterCard is one of the best stocks to buy now. We are going to run through what makes this company phenomenal in every single way, why it should at least at the minimum be on your watch list. We're going to look at the historical performance of this company. We're going to jump into their income statement, look at how well their top line has been, as well as that all-important bottom line, that net income. We're going to jump into their balance sheet, look at how strong the health of this company truly is, looking at that total cash versus that total debt. We're going to look at that all-important dividend safety, some very important financial metrics you need to understand before investing into MasterCard Corporation. And as always, we will run it through our stock valuation model, getting to our intrinsic value and our acceptable buy price given our investor margin of safety. Now, it is a phenomenal company. It's up around 16% year to date, approximately in line with the S&P 500. It is towards the upper end of the 52-week range. However, as I always say in my videos, 52-week high does not mean it's overvalued, and we'll touch upon that shortly. It does offer a yield, albeit a very small one at 0.57%, and shareholders who have been holding the company over the last 10 years would have seen a whopping 490% return on investment. That is incredible, and what we want to understand in today's episode is this a buy now, or if not, at what price, and can we expect to see this incredible return on investment over the next 10 years, as well as seeing that yield and yield on cost going into the double digits. Now, in terms of how well the company has performed, well, on that top line, what we like to see is around 3 to 7% year on year. December 2018, just shy of 15 billion on that top line. 5 years later, December 2022, their latest annual report, around 22.2 billion. So a very nice growth on that top line. On a more granular level, however, 2018 to 2019, we see a nice increase. However, from 19 to 20, which you could justify some part of that decline was due to COVID, with the lockdown not people spending as much as they would normally, we see a decline. However, from then it does pick up very rapidly, and we see that incredible growth. And we'll shortly look at the 10 years percentage-wise too. Now, the bottom line, how has that fared? Well, 2018, 5.9 billion on the bottom line. December 2022, around 9.9 billion. So again, some incredible growth over that 5 years on the bottom line. Again, it does follow the revenue as we see an increase to 2019, the drop to 2020, and then it does pick up. So they're fairly consistent, the top line and the bottom line of this company. Now, a very quick health check. I tend to look at the total cash versus total debt. 8.4 billion of cash sitting on that balance sheet in 2018 for MasterCard. Latest quarterly report, they do hold less cash than they did 5 years ago at around 6.5 billion. Now, in terms of total debt, how does that look numerically and directionally over the 5 years? Well, total debt, what we see around 6.3 billion in 2018, and in fact it has increased over the last 5 years to around 15.6 billion. So they're holding less cash and they are taking on more debt. So this is going to lead us into that all-important dividend safety and our financial metrics supporting this. Dividend safety score straight away 99, making it very safe, the highest score that a company can obtain. Market cap around 379 billion, making it a mega cap company. Now, for those that believe we're heading into a recession, well, the historical recession data shows during 07-09, they in fact maintained that dividend. Recession sales, interestingly, plus 2.1%, which was above the average growth rate for companies in the S&P 500 during 07-09, which was in fact negative growth. And very surprisingly, only minus 12% recession return when other companies in the S&P 500 averaged negative 55%. So a lot to digest there and to understand if you believe we're heading into a recession. Now, dividend growth, they have been paying increasing dividends for the last 11 years. 16% double-digit increase in December 2022. Reminds us that we are expecting an increase in the next few months. 18% compounded annual dividend growth over the last 5 years and a whopping 33%. Now let me know in the comments below if you are getting a 33% increase in your salary or other income producing assets, because this is phenomenal. Not only when we tie this in, but when we look at this with that return on shareholder price appreciation, 490%. So incredible. And one of the things I tell regular viewers of the show to listen for, always get at least 4% increase in your dividends, salary, other income producing assets, because the US inflation rate over the last 40 years was 4%. Anything less, you are taking a pay cut and losing your purchasing power. Now, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. What we see at the moment, 0.57 versus 0.54, you could argue reasonable valuation. However, as I always say, never look at any model in isolation, and we will draw our conclusions towards the end of the episode. Likewise, forward PE, it is slightly lower than the 5-year average, 30 versus 33, and the sector PE for financials coming in at significantly lower than that of MasterCard at 30. As I did also mention at the beginning of the episode, it is towards the upper end of the 52-week price range. However, do understand the top end never means overvaluation. Likewise, the 52-week low does not signal undervaluation. Now, earnings versus free cash flow. Again, regular viewers understand we tend to ignore the earnings. It is here for investors who like to look at this data. The reason for ignoring it is because the earnings is susceptible to manipulation by management through their accounting. So we tend to focus on our free cash flow. Below 60% is what I like. Why that figure? Well, it means that there's room for management to grow to that double-digit dividend we love to see as investors. Well below 60%. In fact, consistently below 20% other than a few years. 2022 at 20%, 2023 at 17% expected. So what this signals to me is that we should be expecting another double-digit dividend increase. Likewise, earnings per share, I tend to skip over. Free cash flow per share, $3.17 in 2013. Oh, well, more than 3 times, in fact, over the last 10 years, with 2022 at $10.40, with 2023 expected to be $13.10. So very strong growth over the last 10 years. Slight inconsistencies as we see growth before dropping, but again, it is going in the right direction. Very positive to see for shareholders. Now, sales growth, again, 3 to 7% year on year. We can see that COVID year where it did drop 9%, but other than that, and 2015, it has beaten what we expect, and it's double-digit growth year on year, which is beautiful to see. 2013, 8.3 billion on the top line. 2022, 22 billion. So almost 3 times as much sales over the last 10 years. Very, very good to see for any company you want to invest in. Now, shares outstanding, you know we love it as shareholders when companies do share buybacks, returning excess cash to our shareholders. So what's also good with MasterCard, not only do you see that share price appreciation, you see that incredible dividend growth, but they do consistent share buybacks. It may not be significant, but even these small amounts do help for investors. 1.22 billion in 2013, 971 million in 2022. So a strong plus there. I mean, this is phenomenal. A return on invested capital, which is one of my 7 golden dividend metrics. The other 6 for new viewers, you can check on the pinned YouTube channel. 10% plus is what I look for. Why? Well, that essentially shows me that management are able to effectively allocate their capital. Year on year, not only has it surpassed that, but it's between 40 to 70%. Absolutely incredible. And another one of my favorite metrics from MasterCard. Look at that operating margin and free cash flow margin. We expect around 12% plus and 5% on the free cash flow, consistently smashing through on that high operating margin as well as that free cash flow margin. The higher the operating margin, the larger that bottom line, that net income will be, which in turn will increase those dividends and return to shareholders. So this is absolutely gorgeous. Now, net debt to earnings before interest, tax, depreciation, amortization. As we saw, they had been reducing on that balance sheet their cash position, but increasing their total debt at the same time. But incredibly, whilst 3 here is the number of years it would take the company to pay off all their debt and net of cash on hand, being our upper limit, it would take them in 2022 less than a year, around 0.55 of a year, to pay off all their debt, with 2023 coming in at a very similar rate. This just backs up that all-important dividend safety score. And on the right, we're just showing the percentage of the company's financing from debt as opposed to equity, with 2022 being 54%. As always, if you are enjoying the content, value is being provided, smash that like button, hit that subscribe button and the bell button if you want to be notified of these stock analysis videos on the daily delivered to your doorstep. And if you want to run your own companies through the stock valuation model, get into your own intrinsic value for your own companies in the portfolio, do click on the pinned description and pick up a copy. Now, Graham's valuation model, we have the earnings per share, 1067, the growth rate per analyst estimates at 18, with that current yield on AAA corporate bonds, again, getting higher and higher at 5.21. This gives an intrinsic value of $225 as we take a look, significantly lower than the current trading price and well below that 52-week low. Now, for MasterCard, personally, I don't believe that Graham's valuation is really appropriate, so we will be excluding this in our final intrinsic value calculator. However, as always, if you do grab a copy of the model, you can play around with the numbers and include whichever models you believe you can justify as appropriate for that company. So the first model we're using, we have the multiples valuation model, companies in a similar sector and size, Visa and automatic data processing. We have their stock price and earnings per share. We get the average P multiplied by that of MasterCard and getting a stock price based on multiples valuation model of $315. Now, as we can see, it does show overvaluation on the current price based on that model, but it is within that 52-week range. Don't forget, as I always say, we never look at any of these models in isolation and we'll draw a conclusion towards the end of the episode. So the second model, we're using the dividend discount model, and you can see here the phenomenal growth rate of the dividends over the last few years, with the average coming at 18%. Now, forward looking, I've estimated around 7.5%, and as I always say, if you want to justify a higher or lower percentage depending on your evidence and your judgments, do grab a copy and you can run your own percentages through. However, based on these estimates and judgments, the DDM price is coming to $490, again showing some very nice upside, around 20 to 25%, and above that 52-week high not seen fairly recently. Now, in terms of the third and final model, the discounted cash flow model, we have our free cash flows year on year with the average growth rate at just under 13%. Forward-looking analysts are estimating around 16%, and with that discount rate at 8%, we get the present value of future free cash flows and terminal value. Add them together with the cash, subtract total debt, and we get to our equity value. Divide that by the shares outstanding, we get a DCF price of $514. Again, significant upside to the current trading price and well above that 52-week high, showing some signs of undervaluation to the market value. Now, the intrinsic value, as always, is the average of the models we've just run through, and for the reasons specified earlier, we are excluding Graham's valuation. And as always, if you do enjoy the content, value is being provided, do smash that like button and hit that subscribe to join this wonderful community. Intrinsic value is coming to around $440. Now, the current price around $402. What do I always say now personally for a margin of safety? I say 10% is sufficient if it has a wide moat, strong financial metrics, good forward-looking data. If you believe that to be the case for MasterCard, your margin of safety would be around 10% and your acceptable buy would be around $395, $396. However, those looking for a larger margin of safety of 15%, you would be looking at an acceptable buy price around $373, $374. Now, personally, my strategy for MasterCard alongside Visa, if you did watch that episode yesterday, these are companies, strong companies that I will be looking to add into my portfolio. Now, margin of safety, personally, I do believe a 10% is justified for MasterCard. These companies do tend to trade at a premium. However, I will be looking to add this with a slight larger margin of safety, just with looms of a recession coming. So $375, it is on the watch list there at that price. I do believe we could see this price over the next few months. So that's the price target that I would be looking for, around $375. Now, those who are interested to know margin of safety of 20%, your acceptable buy price would be around $351, $352, again within that 52-week range. Now, Wall Street are forecasting the price over the next 12 months to hit $466, so they do believe it to have some strong upside even to the current trading price. As always, let me know your thoughts in the comments below. Are you looking to add MasterCard, even looking to sell, or purely on the sidelines speculating? And as always, if you do enjoy the content, hit that like button and do subscribe. We'd love to have you in our community. As always, have a great day and take care.